we are a REIT traded on the New York Stock Exchange. We invest in farmland all across the United States. Today, we own a little over $1 billion of farmland spread across 16 or 17 states. Our focus has historically been in primary row crop farmland: corn, soybeans, wheat, rice, cotton ground. Biggest single state amongst our holdings is the state of Illinois. We also do have some investment in specialty crops, like almonds, pistachios, wine grapes, citrus, etc. Although that's always been a somewhat lesser focus for us. Long-term strategy here is fundamentally to capture two streams of wealth creation for our investors. The first stream is, of course, collecting rents and making an annual distribution in the form of a dividend. And the second thing is to capture long-term appreciation. The asset class appreciates on average about 5 or 6% a year. So when you hold a piece of property for something in the neighborhood of 7 to 10 years, there's a very substantial gain to be had. So we went public in 2014. The history of the company prior to that was I developed with my own capital a pretty substantial holding of farmland starting in around 1996. Gradually built that up to $70-80 million of farmland that we took and used as the seed investment in this REIT. We went REIT. We went down the path of being a REIT instead of a regular company, largely because of the beneficial tax structure for investors. And so that's how we ended up being a REIT. So I'm founder and was chairman and CEO, and now just chairman of the company. Well, at the end of the day, what this is all about is global food demand. And global food demand gradually increases through time. And it increases because of population growth, but more importantly, it increases due to GDP per capita growth. As people get wealthier, they eat a much more interesting and complex diet. That means more fruits, vegetables, and proteins. And if you think about the calorie created per acre of land, once you quit eating all rice or all corn or all wheat and start to have this varied protein-intensive diet, it takes much, much more land to feed a given individual. But the second thing going on at the same time is high-quality farmland gets slightly more scarce every year. Some of it is lost to urban development, new highways, new factories, you name it. We lose a little bit of ground around all major urban centers across the world every year. But then on top of that, we also have seen the places in the world where you're adding land tends to be less productive and relatively lower quality than the land we already have. So what you've got set up here is a very simple story of increased demand for the products coming off the land and decreasing land supply leads to rapid appreciation of the asset class. Well, the big risks in the asset class are some fundamental change in how we produce our food. Now, I don't personally think any of these risks are very significant, but they're worth talking about anyway. One is, could you move our entire food structure to an indoor grow, sort of, a high-tech greenhouse kind of approach and suddenly need way less farmland? I frankly don't think that's possible. I don't think it's certainly not environmentally sustainable. Rain and sunlight in a natural farming environment are essentially free. And if you move everything indoors, they no longer are. The technology, and this has kind of been proven, most of the vertical grow sorts of companies have run into major financial difficulties. And you get, when you kind of push through what all the issues are, it really comes down to these high operating costs. Well, a couple of things. One, there are some other big pools of investment capital in agriculture. Most of them are private. And so to participate in that marketplace, you've got to have hundreds of thousands, if not millions of dollars to make an investment into the private fund that's going to invest in farmland. We are, of course, a public company. There is one other public company, but what that does is that lets an investor with a relatively modest amount of money, as little certainly as 100 shares, and frankly even less, come in and own a small piece of American production agriculture. The second thing, though, you get, which is always an issue with farmland, is you get daily liquidity if you're traded on the New York Stock Exchange, and you don't have daily liquidity if you just own a farm or own a percentage of some sort of private vehicle that's owned in farms. So I think those are the two differentiators.